Andreas, sollen wir pünktlich anfangen?
Ja, fang mal an.
Okay. Welcome to today's 7th International Breakfast Meeting in the 111th year of the Rotary Club of New York, so named the Host Club of America by Rotary founder Paul Harris on April 1st, 1926, during an address to our club. Our guest speaker today will be Thomas Missong, President of the European Association for Credit Rating Agencies. The introduction of today's speaker will be by Andreas Rungacher. He's the Executive Director of RCNY. We will then have the presentation by our speaker and then a Q&A moderated by me. I'm the chair of the breakfast, and directly following after will be a meeting of the International Service Division. So I look forward to the introduction of our illustrious speaker by Andreas.
Thank you very much, President Jasmine. I'm personally very delighted to have my dear friend Thomas Missong as our guest speaker today. As Jasmine said, he's the president of the European Association of Credit Rating Agencies. Since 2010, Thomas is the president of the European Association of Credit Rating Agencies, registered in Paris, France, currently representing 9 credit rating agencies registered in the European Union and 3 in Switzerland, Turkey, and Russia. Additionally, Thomas is a managing director at Rating Platform, a specialized website on ratings on a global level. He acted as independent board member of Russia's leading agency, Analytical Credit Rating Agency, from its establishment in November 2015 to July 2020. Prior to that, Thomas was executive director of AAA Corporate and Rating Advisory, a 100% subsidiary of UniCredit Bank Austria in Vienna, acting as communication channel between the bank clients, and the international rating agencies. In the past, he worked as a project manager in Bank Austria Kreditanstalt in the energy and utilities team in Vienna, and as project manager for Lyonnaise d'Eau, the leading global water utility in Paris. Thomas Missong has a master's degree in European political affairs from the College of Europe in Bruges and holds a magister in business administration from Wirtschaftsuniversität in Vienna, with focus on capital markets. It is truly a delight to have Thomas here today. And Thomas, the floor is yours. Thank you.
Thank you, Andreas, for the introduction. Many thanks for inviting me to this meeting. I hope you hear me well and you can see me also. As you heard, I'm focusing on credit rating agencies, and my presentation today will be on behalf of the association. I will speak about the coronavirus and the impact on credit ratings on the one hand, and will lead thereafter to speak a bit about the industry structure, and finally on the international framework for rating agencies, as I believe that your club has also a very international attention or format. So I have prepared a presentation which I will be sharing with you now. I hope that works out. Oh, backwards. So I hope you see you can see the slides. Before we start, obviously, just a short introduction to credit ratings to give you a bit of a framework. I don't know how familiar you are with the topic. I don't want to do it too technical at this stage. Obviously, whenever there are some questions, I can try to do a deep dive into specific topics. But generally speaking, credit rating is an opinion on the creditworthiness of an entity using an established system of ranking system. So the classical AAA, AA, A, and BBB, and it goes down further, with the AAA being the highest mark, obviously. Credit ratings are important to the financial system for several reasons. The first one is that it covers a number of market segments, huge market segments. Obviously, one of the largest asset classes is the sovereign market, but equally the sub-sovereign municipal market. All the banks, all the insurances have, or nearly all of them have credit ratings. Classical corporates have ratings, and then more specialized for the European markets are covered bonds and the classical structured finance market, which is obviously pretty famous because of the global financial crisis, which was particularly linked to this market class. So on the one hand, you have all these issuers, but on the other hand, you have all the users of ratings. And this is a very large group of players, with all the banks, all the insurances, asset managers, investment funds, pension funds, taking into account in a differing degree, but still all of them taking into account credit ratings. I should have added also central banks on that list, because it is also an important topic. So this is the short introduction to ratings. Just briefly, here you see our members, which and a geographic background approximately. So most of our members are based in Germany, and then we have Spain, Italy, Switzerland, and so on, as Andreas had said already. And we have here also, as one of the big international agencies, also AM Best, which is focusing on the insurance market. But I don't want to spend too long on presenting my members, because it would take me quite some time to get you through all of them. As I said earlier, this is the background on which our association operates. You see on the right side the issuers, the market segments which I had mentioned. On the other hand, the users of ratings, and then the environment. Obviously, for us as a European association, we look at what happens mainly in Europe in terms of regulations, but also in terms of supervision. And on the same time, we need to take into account the global environment, because it feeds into the discussion in Europe, but also backwards. So it goes, it's not one direction only, it goes in both ways. I would need to add that at this stage, there's only a global environment, but not a global framework for rating agencies. Now, let's jump now into the topic of the coronavirus. As you know, this has changed the life for everybody, I would say, and for much longer than everybody would have thought at the beginning. And you see here a study by Fitch Ratings on the impact of this coronavirus, depending on the sector. And the obvious one is here the negative rating actions in terms of lodging and leisure and transportation. They were highly hit by the coronavirus, simply because all the hotels are closed, restaurants are closed, airlines transport less people than before. But already on the third place, you have the sovereigns, who have taken on quite a lot of the burden, or taking out a lot of the burden out of the system. Overall, you see that the green fields, the positive actions, are very small compared to the overall situation we have with negative actions on the creditworthiness. At the same time, you have here also from Fitch Ratings a regional impact. You see that nearly all regions were affected by the coronavirus. There is no big exemption. The shares here reflect rather the coverage by Fitch Ratings than the impact. So Fitch is one of the big three agencies from the US, and has a huge coverage in North America and Europe, and that explains the big parts. But it is a global global crisis, which is somehow confronting because as everybody is hit by this crisis, you have, in terms of ranking, everything moves on the same level downwards, but in ranking terms, they could remain the same. Now let's look at the historical view. On the right-hand side is where we stand currently here with the blue line showing the number of downgrades. And this corresponds to the level we had seen at the time of the beginning of the financial crisis. We need to note that the figure for 2020 relates only to the first half of the year. So a huge number of downgrades we had, and expectedly probably higher than the one in terms of the financial crisis. And additionally, what is interesting is also the gap between the upgrades and the downgrades. We have a historical high gap between the two. So the outlook is not at all positive, and it seems that we are having a situation again as we had after the financial crisis. The good thing is that we have very committed central banks. This is a graph taken by Scope Ratings, one of our members, and who has a wide coverage on sovereigns. And here they are forecasting that all central banks will be buying up additional government debt in order to support the economy. You see this for the US, but also for the ECB, and a very sharp rise from the Bank of England and the Bank of Japan. Overall, we need to say that you had on the one hand the rating downgrades, which would mean increased capital requirements to users of ratings. On the other hand, there were very strong supportive measures from at least in Europe, but also in the US, but I know better the situation in Europe, where you had huge programs coming from the European Union, but also by the member states and also by the European Central Bank, which has alleviated the impact of the crisis and also diluted the impact of the rating downgrades. For instance, there were a lot of government guarantee schemes which were implemented, which resulted in decreasing substantially the capital requirements to the banks. So on the one hand, we have recently had the Ms. Lagarde, the chair of the European Central Bank, who complained about credit ratings and the downgrades. But in fact, the reality is that according to the European Banking Authority, the capital requirements were actually decreased because of government programs. So this, as a short background for about the crisis and the impact and the result of the ratings. What is the concern from our perspective is obviously the fact that we have an oligopoly in terms of in the market, in the rating market. There are the three big players you all know, Standard & Poor's, Moody's, and Fitch, who control the market. And even though in the US, the goal was also to increase competition in the market, we see that it has even decreased. And we see the same trend also in Europe. This graph goes only until 2017 because the US SEC has not published the latest figure in its annual report anymore, so I cannot bring it up to date, but it is clear that we have still this huge market concentration. Obviously, from my perspective, representing the smaller players, this is one of our largest concerns, but it has also a big impact also for everybody. So because of the high fee, or the high market shares of the big three agencies, they are able to charge very high rating fees on all sides. So whether you get you request a rating, or on the other hand, you request rating data from the big three, you have to pay very high fees to them. So that is one drawback of the competition. And the second one is also on in terms of a risk to financial stability. So we observe that the big three agencies, the graphs I've showed you earlier were from S&P and Moody's, but you would see the same one from, S&P and Fitch, but the same trend can be seen by Moody's. So a very similar approach in terms of rating activity. And this has obviously an impact. And we saw this reaction on the market in March, where the downgrades triggered fire sales by a number of asset managers. Now, and this is clearly a risk to financial stability, and therefore we believe that users should take into account more agencies in their assessment, as it contributes to more information, but also increases financial stability. There was a huge discussion some time ago about alternative to ratings and whether ratings should be abolished at all. This is what Brazil did, but otherwise ratings are still in the framework and will remain there. Here again, I show you briefly all the agencies which exist in Europe, so about 30 agencies, and more than 10 of them are active in the sovereign rating market as one of the biggest asset classes. And I have here summarized the schedules of rating actions of all the agencies in all the countries. So for instance, if I take the example of Germany, you can see here that there are 10 agencies who are rating Germany, and that on average you would get a rating action every 2 weeks. So you would get regularly information on the issuer and can then assess and make your own assessment. This is followed, for instance, by Portugal and Spain with 9 agencies covering. So far more than the 3 agencies you would normally consider only. Turning to the market in Europe, I mentioned earlier, the market share in Europe is approximately the same than on a global level, dominated by S&P, Moody's, and Fitch. But the reality is that the other agencies employ more than half of all the staff in the rating industry in Europe. This share comes actually from the fact that the UK has withdrawn from the European Union, and about half of the staff of the big 3 agencies in Europe was based in the UK. So the message of here is that small agencies employ a lot of resources and have a huge insight, and should not be just measured against the small market share they have here in Europe on paper. Now I'm getting to my last slide already. This is about the global market. This is potentially quite a technical issue, but in reality, there is no global framework for rating agencies similar to any other industry, and you have each time to get recognized or registered with your local supervisor. And the European Union has opened its market, as well as the UK, to some countries, which is the US, Mexico, Japan, and some few others, but it's obviously not a global market. And it is only a one-way opening. So US agencies can operate in Europe, but it's not the other way around, that European agencies would be accepted and recognized in the US. And then there is a small framework, especially in the banking industry, which speaks about international credit rating agencies, and this is something which S&P and Fitch and Moody's use a lot, where they get recognized indirectly to be accepted in nearly all countries. So we don't have a level playing field on a global level, but obviously, if you're looking at European assets, my recommendation to you would be that you also look at what European agencies are saying, as they should have quite a good insight into the credit risk here. That was my short presentation. I hope I was in time, and I look forward to any questions.
Mr. Missong, that was fascinating. Thank you so much. So as you all know, I'm going to be moderating, and I would like to ask everyone, when you ask a question of Mr. Missong, that you please be on camera. So as he is clearly visible to you, I think it makes sense that we return the courtesy of our live presence also, and that we stay within our cultural norms and be polite about the questions that we ask. And so I see that Larry Parks has his hand up. So Larry, the first question goes to you.
Okay. So first, thank you very much. I've been fascinated by this rating stuff for a long time. I run an organization that's focused on the monetary structure. My question to you is that every country now has it as official policy to depreciate the purchasing power of its currency. They call this inflation targeting. My question to you is, if the purchasing power of a sovereign's country, that could be the dollar, the euro, or any other sovereign currency, were to fall to zero or close to zero, and all of the outstanding sovereign's debt was paid down with near worthless currency, mindful that the creditors would not receive anything of value, would that or would that not constitute a default in the opinion of your agency?
Thank you for your question. I'm myself not a rating agency. I'm just an association of rating agencies. So I cannot give you like an official assessment on this question. And I would assume that my members might be discussing a lot, providing a more precise view on this. My thoughts would be that if you look at government bond yields in Europe, they are negative for Germany for 10 years and even longer. So basically, if you invest as an insurance company where you need long-term assets into German bond, you are losing money actually already now. And this is actually the terms which are proposed to you. So from a rating perspective, if an agency, if an investor buys this paper and he gets less than expected, well, he's getting less than he had before, but that's the amount he was expecting to get. So that would not be a default. In terms of the central banks, I heard just recently Ms. Lagarde saying that basically they can buy up everything they want, and even if they make losses on it, she does not care too much, because simply the central bank is the only institution in Europe which is allowed to print money and therefore has always liquidity available. Yeah, that's not. I was pretty astonished when Ms. Lagarde made this very open statement. I would think.
May I continue?
Are there any other questions?
Jasmine, may I come back?
Okay, but we want to give others a chance to ask questions too. Okay.
Okay. That statement that Ms. Lagarde made, Mr. Greenspan has made the same comment. The idea is that They can never default because they can always print the money. We recognize that. The issue is history shows that whenever you have paper money, the purchasing power goes to zero. A lot of these creditors, people who hold these bonds, they're in pension funds, they're insurance companies, they're not mindful of the history of this, and they're not mindful of the strong possibility that these bonds will never be paid off with money that has perhaps any purchasing power. And my question is, it's not for you to decide. Just well, what's your view on this? Is that a default if someone is paid off with worthless money, as opposed to not being paid off at all?
My understanding would be that rating agencies would look at the face value, at the nominal value, face value you are getting back. So as long as you, if the German Bund says for a bond today you buy 100 and you get back in 10 years 89 or 98, if you get that back, then it's not a default.
Okay, so we move on and we're going to, does anybody have a question? If you could please let me know. If you don't know how to raise your hand visually, just raise it like this, and that way I can see that you would like to speak. Thomas.
Yes, good morning, Jasmine, Andreas, and all the visitors. Thank you very much, as speaker. It was a very interesting show. I have a question where you mentioned how the central banks will purchase some of the government debt.
You're breaking.
Is that a way to get around the rating, the credit rating agents? Can you hear me?
Barely. Could you repeat the question, please?
Yeah.
No. Okay. Thomas, you typed it in. I think the question was, when the central bank buys government debt,
You read up there?
is it then not counted as a government liability, whereas when they sell bonds to privy institutions, it is considered debt? Is that correct?
Can you hear me?
Mr. Missong, we can't hear him, but I think his question is in the chat, that when a central bank buys government debt, is it then not counted as a government liability? Whereas when they sell bonds to privy institutions, isn't that considered debt?
Frankly speaking, I need to. I cannot give you the short answer. I can only tell you what I can observe. So I don't know the accounting treatment on, frankly speaking. But what I can see is that the central bank in Europe has bought up a huge amount of government debt in the Eurozone. So the central bank alone holds more government debt than all the banks in the European Union together, or than all the insurance banks or insurance companies together. So they have something like 25% of all government debt, and that explains why the premium, the spreads are so low, because simply the central bank buys up everything, whatever they can get. And they have committed to continue doing so. And they do it on both markets. They do it on the primary market and also on the secondary market. Yes.
So now I have a question, and it's twofold. It has to do with currency and valuation. So the euro is very strong despite all of this printing of money, right? And then there are talks about introducing what might be a digital euro. Any thoughts on that?
There are some discussions ongoing here. It's still in the preparation phase. I think that the Swedish central bank was more active on that side and started discussions earlier. And we have here also discussions on starting in Europe. But I cannot tell you how quickly this will be really emerging. So usually the central bank is quite cautious in its actions, and this would be obviously a very big step.
I think China is introducing a digital currency, right?
I think they have also plans doing so. What I know is that Europeans like a lot cash money.
I mean,
So
the thing is, how would that influence credit ratings across the board if something like that would be a momentous event, right?
well, the threat for the central banks in digital currencies is that they might be losing control over the currency and the monetary power they have, and that's why we have now also in Europe's first steps in terms of regulating cryptocurrencies. But it's not yet decided. So first steps coming in. How the digital euro would compare to the real euro, whether they would be linked to each other, whether they would be the same exchange rate 1-to-1. Honestly, I'm not an expert in that sector.
I think we can agree that there is a certain amount of volatility in this area coming to us. John, German.
Yes, I follow impact investing closely,
Okay,
and
John,
the global sustainable development alliance at the United Nations, which was founded.
John, you need to get away from your
Yes.
You need to get away from your microphone a little bit because it was very distorted. Could you repeat your question, please?
Okay, can you hear me now? Yes? Okay. Impact investing has unleashed a lot of new rating systems for rating impact. Is your association going to limit its?
I'm afraid I did not understand the question.
Okay, the way that I understood it was that there are other players who want to be in the system, in this rating system. Are you going to create a more limited club, so to say, of credit rating agencies, or is any player welcome to go and play on the field? I mean, I could even see Amazon with like a few $1 billion going in there and trying to do whatever they want to do. I mean, they pretty much have unlimited money.
The question is about impact investing. Is your association taking on impact investing, or are you limiting yourself to pure credit worthiness?
Yeah, well, impact investing is a huge topic in Europe, and it is very high on the agenda now with the European Green Deal and so on. For us as an association, we don't give any guidance or recommendation to our members. It's our members who decide themselves whether they integrate environmental and social topics into their credit assessments. And I see that there's a pickup coming from the members. So 2 years ago, there were only 3 of our members who were looking at it. And in the meantime, it's about 7 of them. And I expect some additional ones to come in, simply because it is such a huge topic. The question is how you deal with this impact investing, and whether you integrate it directly into your credit rating or whether you do another product out of it. So in the regulator in Europe, ESMA, has clarified that you are not obliged to include it into your credit assessments, because it would be outside of the regulation, which says credit ratings only. But if you consider some topic to be material in your credit rating, which is a social or environmental issue, then you should be giving explanations on it and giving some transparency on it. So like highlighting the issue. That is the credit rating side. There is also the so-called sustainable rating agencies. These are currently not regulated in Europe at all. So you don't have any laws saying what they need to adhere to in terms of methodologies, transparency, and so on. But there is a big discussion in Europe, and I expect that within the next years, they will be regulated. But from our perspective, we don't interfere into it. We focus on the credit rating side, and what happens on the sustainable rating side. Obviously, we are considering it, but it's up to policymakers to make the decision. And the last point would be, what is the purpose of regulating those agencies? Is afterwards, it has no impact in terms of what banks do with it. So credit ratings are regulated because they define the capital requirements of banks. So therefore they need to be well regulated and well supervised. But the sustainable rating agencies, it would be an improvement already to have them regulated, potentially, to be sure that it is working according to good standards. But if it is not reflected afterwards in any impact on your capital requirements, it is potentially a trendy subject, but not really of essence, to be very honest. But it's trendy, yes.
Do we have any other questions? If not, I have one for you, and that would be just to give us an insight during COVID, what life is like for you to do your job, because you can't travel anywhere, you can't meet anyone. There's a lot of uncertainty around. Could you share with us how this even works? Because this is usually done, it's more like a people thing instead of just a computer thing, if I'm not wrong.
Mm-hmm. Mm-hmm. Yeah, well, I can tell you with my experience with the agency in Russia, where I used to be a board member until July of this year, we had to switch from basically one day to the other, from a company where it was expected that everybody would be in the office to remote working. And we managed this within 2 weeks' time to have everybody working remotely. And that was quite a change in culture, obviously. And to organize this internally, that it works properly, was an issue. We are lucky enough that we have this modern means of Zoom and other platforms, which makes life much easier. It would have been unthinkable, let's say 20 years ago, this situation. So that's on the side of the rating agencies in itself. It was a change in terms of organization, but the processes and everything were pretty established, and the work continued. And as it is a general issue which affects everybody, also the issuers, but also the investors, everybody got used to work with this new format, I'm afraid.
Are there any other questions? Because if not, I'm going to be closing this out. Anyone?
Yes.
Yes. Who is speaking?
John German.
Okay, John, yes.
There were major scandals with rating agencies giving ratings that the market later showed were bogus, were not supported by facts. Could you describe any of the effects that you and your association have seen about those problems and those scandals?
Well, the issue with rating actions is that it is, for some it is too late, for some it is too early, especially when you look at sovereign ratings. Whenever there's a downgrade of a country, the respective country is complaining, and the other ones don't say anything unless they get hit by a downgrade. And usually it is when one of the big three are taking action, and at some of the thresholds where this magic border of BBB minus downwards, then there's usually the biggest complaint. The big scandals, there were some big scandals, obviously, with the which led to the global financial crisis, where some say that the agencies, the American agencies, played a big part in this. Now this has happened. I know that there were some recent smaller scandals also in the US, but I'm not so familiar with the details that I would be speaking to be able to speak about it. In Europe, there should be a system, as they are regulated and supervised, where ESMA monitors what the agencies are doing and basically can also issue fines, and quite huge amount of fines, especially for smaller players. At the end, rating agencies are also human beings, so errors can happen, but with all the regulation in place, errors should be hopefully limited over time.
So my last question is just for you to project into the future. What do you see coming in the next between 1 and 3 years in great trends?
Well, would you have asked me that question last year? No one would have answered to you that we will have a corona crisis and a pandemic crisis. Actually, this is a key point. We don't know how these things will continue, simply because there is no real benchmark. Well, there was a Spanish virus in the early 1920s, but still we are in a very different situation. The question is, we have now huge government support programs, for instance, if you look at insolvency bankruptcy statistics in Europe, they are record low in 2020, simply because all of these government supports. And as soon as those fall away, we would expect that the bankruptcies will be material. They will lead to higher unemployment rates, increasing the fiscal burden. You have additional sovereign debt taken on by everybody. So the midterm perspective outlook is not too rosy, to be honest. Let's hope that this health crisis gets over quickly, and then that we have a medium-term path return to growth, because that will be the only way out of that debt levels we have currently. There are some people saying that there's this new monetary policy saying that you can take on as much debt as you want. Let's see if that monetary policy or theory will prevail. At this stage, I think that it's like everybody's in a wait and see position. But I cannot be more specific what it will be in 3 years' time.
I was just like, because we all are thinking, even if we might not verbalize it, we wonder how it might turn out, and hearing other people's perspectives sometimes helps us clarify what our anxiety level is. So which at times can be very high for certain people like me. But thank you for a most informative session. This was really, really interesting. Andreas, could you please speak quickly to the next meeting that is coming up on January 27th?
Yes, absolutely, Jasmine. First, I also wanted to thank Thomas for his presentation. He and I actually go back to the mid-'80s where we met in Sussex near Brighton, and our parents sent us there to learn English. And obviously,
Me too.
Yeah, great. So that's how we met. And then, of course, we had the pleasure to reconnect in Vienna, which is still a city of my heart. And so my big thank you goes out to Thomas. And please come to our meetings again when we have even more attendees. Today is obviously inauguration day, so the attendance has been a little more modest. But next week, I don't know, I could call on Bolar since she is actually organizing this program. Bolar, are you able to speak to us about next week?
Oh, yes, definitely. Thank you so much, everyone. Thank you so much for an amazing presentation. So we're going to have next Wednesday, I apologize, 27th of January, 7 to 8 p.m. Eastern Time, Chandler. So we're going to talk about the future and the Great Reset. And the second speaker will be Helen Orr. She's past president of the Rotary Club of Baby Sunshine, Hong Kong, and seasoned consultant and executive coach. And she's going to talk about applying futures thinking as a leader. So it's going to be pretty interesting, and we definitely want to discuss about future. And yeah, and I'm very excited about this. Thank you so much.
Thank you so much. That really does sound interesting. I want to let everybody know that after we close this meeting, John Germain has the International Service Division meeting. So while I am leaving because I have another meeting going on after I close, the meeting will stay open so that the International Service Division can meet. So I'm going to close the meeting with thank you for honoring us with your presence today. And thank you to our guests and visiting Rotarians. We welcome your return in the future. Rotary, the organization that empowers its members to become better friends, better professionals, and better world citizens. So I thank everybody for joining us today. And I say goodbye. And Jermaine will take over. Mr. Missong, thank you for really what I consider very, very interesting session. Thank you, Andreas, for setting it up. Bye-bye.
Thank you.
Thank you.
Thank you.